Okay, here's another puzzler for the group. Welcome back, options traders, and here's a question that I get a lot. Can you overcome the time decay? Or can you beat the time decay? It's another way that I hear it phrased from some of the new traders. And what they mean by this is, if I sell an option against maybe my long position, can I neutralize this time decay? And in some cases, yes, but you have to be very careful about phrasing it that way because it sounds like you're getting something for nothing. And as I always tell traders, options are always about trade-offs. Whether you buy, sell, hedge, roll, morph, it doesn't matter. You're just creating trade-offs. And there's a particularly potentially dangerous one when you try to overcome time decay. So what we're talking about here is theta, which most of you are familiar with that, one of the Greeks. And all this means is that part of your options price decays a little bit over time. And traders often believe that theta is a risk. And I've talked about this also in a couple of other videos. Remember that theta is not a risk. It's a characteristic of an option. Why is it not a risk? Because time moves in one direction at one speed. We know that if you pay $5 for an option today that has 30 days to expiration, we know in 30 days it's worth $0. It's an absolute 100% known. Now, of course, that doesn't account for the intrinsic value, but we know that the extrinsic value is worth $0. So how could that possibly be a risk when we can predict that outcome with 100% certainty today? See, that's why it's wrong to really look at theta as a risk, like it's some type of unknown. It's not. We definitely know how it's going to behave over time. But the problem becomes when traders try to avoid theta. And again, usually they do this because they think that it's a risk. So the thing that traders often do is try to avoid theta. You hear a lot of people talking about this. I just want to figure out how to avoid theta. Well, think about it. Can you really avoid theta? Or is there a trade-off? See, if you could avoid theta, or preventing theta, is the same thing as stopping time. You can change how an option or a strategy behaves over time, but you can't stop time. And so that should be a little bit of an indication that tells you there has to be some kind of a trade-off. So let's look at a simple example and find out why it's not so easy to just overcome theta. And to do that, we're going to look at two different traders, and we're going to put the stock at 100, and we're going to say that trader A buys a 15-day $100 call. So it's an at-the-money option, and trader B says, you know what? I don't want to be exposed to this heavy time decay of a 15-day option. So I'm going to outsmart it. I'm going to buy a 30-day $100 call, but I'm going to sell it after 15 days. So both traders will end up holding these options for 15 days, but trader B will not lose 100% of the premium. So again, this is a very simple tactic where traders will say, I want to buy a longer dated option and sell it back to the market so that I don't lose 100% of the premium. Sounds simple, except that it's not so easy. Is there a cost? Well, yes. Remember, there is always a cost, and to succeed with options, you need to figure out where that cost is. So for this example, let's jump over to an Excel spreadsheet and see if we can find the hidden cost. Okay, so now that we're into the Excel spreadsheet, let's take a look at some of these numbers. The first column that I'm going to cover right here is column E, and these are just option prices for a 30-day option, 20% volatility, no interest rates, and we're just letting it move across time. So these are assuming the stock price stays exactly the same, volatility stays the same, we're just letting time tick away. Now, it doesn't matter which numbers you use. You're going to get exactly the same conclusion, and that's really what's important here. So don't worry about which volatility that I picked and interest rates. It's got nothing to do with it. The second point also is that I just wanted to have an option that was a longer dated option and one that was shorter dated. I normally wouldn't advocate a 15-day option, really even a 30-day for that matter, but if we did this on maybe more realistic terms where we're comparing, let's say, a 6-month option to a 2-month option, we would just have a very, very long list of numbers to have to go through here. So I'm doing it just to keep this window small. Okay, so that's this first column right there. And then the next column is showing the total amount of decay. So on day 1, this option is worth $2.29. On day 2, okay, 1 day has passed, it drops from $2.29 to $2.25. In other words, a loss of 4 cents. So this trader experiences a 4-cent loss. The next day it drops from $2.25 to $2.21. It's now an 8-cent loss from the original purchase price. And so you can see that at the very bottom, eventually the entire $2.29 is lost. Now this is Trader B, the person that's trying to avoid the time decay. Trader A, if you remember from the presentation, is going to buy a 15-day option and just ride it to the end. So using these same prices, again, we have to assume everything's the same. That's what a 15-day option looks like moving through time. It would cost $1.62 today, and that would be worth 0 at expiration. So I'm just going to take these numbers in red and paste them right there. So now we can make side-by-side comparisons. Again, Trader A buys the option, the 15-day option, for $1.62. Trader B pays $2.29 and is planning on selling it right here. So look what happens. Trader A pays $1.62, stock price stays the same. 15 days later, it bottoms out to 0. He's out of $1.62. Trader B pays $2.29. He bought the 30-day option, but he's planning on selling it 15 days later. What's it worth in 15 days? Well, that's what the price of a 15-day option is worth, $1.62. So he pays $2.29 and collects $1.62 when he sells it, and therefore he's only out 67 cents. And this is exactly the trap that people fall into. They say, well, would you rather lose 67 cents or $1.62? Well, obviously 67 cents is a much better amount to lose, and so they say case closed. Well, not necessarily. For a few reasons. First of all, take a look at the total price paid. Trader B pays $2.29 and so could potentially lose $2.29 instead of $1.62 if the stock moves against him. And so we can see that over here in these two graphs. Now this red one is the shorter dated option, and it's just showing the decay, and the blue graph is showing the decay for the longer dated option. So yes, we can see that the red curve, the shorter dated one, decays at a faster rate. And in fact, it only gets worse over time. That's why this gap starts getting bigger. And right here, that's minus $1.62. That's that value right there. And in blue, directly above it, is minus 67 cents. So it looks like a no-brainer. Like, why wouldn't you buy the longer dated option and sell it after 15 days? Well, again, the first answer is that if the stock moves against you, you could potentially lose $2.29 instead of $1.62. And that's being reflected by this blue curve sitting lower on the chart. See, just because Trader B decides to, or at least thinks he's going to sell it after 15 days, doesn't mean he can do that for $1.62. The stock might have collapsed. And so now he's got $2.29 at risk. So he might choose to hold it for another 15 days, which is the distance between the red and the blue out here, and finds out the stock never gets to his strike and he loses the entire $2.29. So there's your trade-off. Yes, you are decaying faster on the red curve, but you're not decaying as deep into the graph. Now you might say, what was the cost of this? Well, think about it. Trader B is trying to avoid this $1.62 loss. And in order to do that, he has to pay $2.29. How much more expensive is that? 67 cents, exactly what he thought was the amount of the benefit. So it's not for free. You had to pay 67 cents in order to have a 67-cent loss, assuming the stock stays still. But now that raises another question. Why would you buy an option thinking that the stock is going to stay still? So let's take a look at what happens if the stock price now moves. So now we're going to look at exactly the same two trades, but we're going to assume that the stock either moves down to 90 or as high as 110, right up to here, but it's going to happen within the same day. So we're just going to see the effect of a stock price move. So here's our shorter term option in red, and it always sits above the blue. It always outperforms the longer dated option. Why? Because you paid more for the longer dated option. You've got more to lose if the stock goes against you, and if it goes in your favor, you've got fewer deltas. Your shorter term option has a larger gamma. It's going to accelerate you into those deltas. It's going to hit delta 1 long before the longer dated option. And so it's going to outperform. That's why the red line sits higher than the blue out here, and the red line sits higher than the blue out here. The shorter term option loses less, and it can potentially gain more. So what is the benefit? Why might you pay that 67 cents? Well, that's if something happens in between. Maybe the stock price moves and some time goes by. And to see that, we're going to go to this page. We're going to look at these exact trades, but we're going to look at them 7 days later. So the 15-day option has 8 days to go, and the 30-day option has 23 days to go, but now we're going to look at the stock price making those same moves. So from here, from 90 to 110. We get the same results, almost. The shorter term option in red outperforms. It loses less than the blue if the stock collapses. And the red line sits above the blue. It outperforms the longer dated option if the stock moves in our favor. But you can see that if the stock stays fairly quiet, this is the only region where the blue curve sits above the red. Why? Because it's not decaying as fast. But you have to ask, is this little tiny sliver of a potential gain, which remember is not part of your outlook, this is assuming the stock price stays still, is that little tiny sliver worth having a much bigger potential loss if you're wrong, or having a smaller gain if you're actually right? Remember, this is supposedly the reason that you bought the call option in the first place. You think the stock is going up. And so if you're right, you are absolutely going to put fewer dollars in your pocket. Now, how many dollars fewer? Well, let's take a look at this column. This right here, column G, is looking at the difference. And look what happens. You're 61 cents better off, and then pretty soon, very quickly, go to 67 cents, and you never budge. And that's because both options eventually are going to hit delta 1, but you paid 67 cents more for the longer dated option. And that's why this gap right here will eventually hit 67 cents and never ever change. So did that come for free? When we look back here, this little savings of 67 cents? Absolutely not. It's just simply a trade-off. But the trade-off is that you might do a little bit better, a little bit, if the stock is quiet. But remember that that goes exactly against your initial outlook. So if you get nothing else from this video, always remember there is a trade-off. Every single step and action that you take with an option, buy, sell, long, short, add to a position, subtract, hedge, roll, morph, are all going to create changes. Not something better and not something worse, just things that are different. Now those things might be better for you, and that's where you need to understand your strategies to figure out if it is better for you or worse. And that's why it's so important to understand your options strategies. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.